And welcome to ETF Edge. This is your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Dave Nadig of ETF.com, John Davi of Astoria Portfolio Advisors, regulars on ETF Edge. Let's kick it off with a huge week for earnings. All eyes will be on the FANG stocks. Facebook, Amazon, and Alphabet all out with reports. These tech heavyweights make up roughly 8% of the S&P 500 market cap weighting. Three stocks, 8%. Think about that. So aside from the obvious SPY, SPY ETF, what other ETFs could see the biggest impact from these reports? Dave, this is your area of specialty.
Sure. So if we're talking about broad-based ETFs, really, 8% is about what you're going to find in most big, large-cap ETFs. If you look at things that focus, say, just on the internet space, though, like the First Trust Internet Fund, which is FDN, that's 23% in these names. Now, that may sound like a lot, but you start getting into some of the sector funds that own these, like communications or retailers, and individual stocks there can be 23%. 23% of, for instance, XLC is in the two Google share classes.
John, is the FANG moment come and gone? Have we made too much of these five names? Should we start moving on and get other acronyms? I know Jim Cramer has been trying to come up with a few. He's always very good on this, and he invented the FANG.
Yeah, I think you want to shy away from FANG and cyclical and growth stocks. I think you want to lean more on like stocks that have strong earnings, high quality stocks. That's the premise that we've been riding in our portfolios all year, and I think that makes a lot of sense. So.
Where should we go from here then? So I have complained mightily for years that these stocks get too influential in these indexes. The five FANG stocks are 1/8 of the S&P 500. Five stocks, and there's 500 stocks in the S&P. The top 10 are 21%. I know I've complained about this. Is there a reason for us to be worried about that?
I think so. I mean, as you get bigger in size, market cap, then you're going to be a bigger driver of these indices. So my whole premise is to invest away from market cap, to invest in factors, quantitatively driven ETFs.
Yeah.
So.
But you tell me to calm down. Every time I bring this up, you say, Bob,
look,
please.
There are plenty of ways. Well, first of all, there's a reason that people generally cap weight, because the market sort of self-corrects these things. But I think it is reasonable to be concerned when we get to frothy markets and these high concentrations. There are lots of ways to insulate your portfolio from some of these moves. You can buy reverse cap-weighted ETFs, which effectively will underweight things that are over present in the S&P, or you can just go into any number of factor.
Has that ever worked very well, underweighting the reverse cap weighting?
It effectively turns it into a mid-cap fund, and definitely when we see these big, large-cap momentum names like a Google, Amazon, Facebook, when they inevitably fall out of bed, the mid-caps tend to be what come up and pick up the slack.
So it's good contrarian play if you believe they're going to fall down.
100%.
Okay, I want to move on here because I want to get some ideas from John here. We have roughly 5 months left in 2019 with the markets at all-time highs and the S&P sporting a nearly 20% return this year. Investors are looking for ways to position themselves. Going into year-end, John, you brought along 3 ETFs you think bear watching. I know you're very big on gold, and gold's just started taking off in the last 6 weeks after being a loser for years. Gold stocks as well. Why do you like gold and gold stocks?
Well, I think your opportunity cost for owning gold is low, so you've got rates that have been going lower. Meanwhile, recession risks have increased. I mean, the bottom line, S&P is up 400% the last 10 years. Gold is up 50%. The miners are down 10%. So, I mean, recently one of the greatest hedge fund investors ever says he likes it. I think that's a huge catalyst for gold. So I think a 5-10%.
You're talking about Ray Dalio at Bridgewater.
Correct, Ray Dalio. So I think a 5-10% allocation to gold, it helps diversification. It gets, higher risk-adjusted returns.
And I know you like quality as well. You're big on earnings growth. You're big on dividend growth. There's a firm out there, there's an ETF out there, DGRW, that really does both.
Correct.
And yet, it sounds like a great idea. I like quality too. Does it actually outperform?
Well, I think, if you look at like risk-adjusted returns, it has outperformed the S&P 500 since inception. So we like that. I think, we like it because if you buy just pure qual, like the QUAL ETF, that's trading at like 19, 20 times earning. The S&P is at like 17 times.
The difference here is this has earnings growth and dividend growth on top of it. And the difference between that and QUAL is what?
So qual is just pure quality, whereas DGRW takes 50% quality screen and 50% like earnings growth screen. So I think it's a nice blend.
Okay.
Bottom line, DGRW trades at 16 times earnings, S&P, 17, 18. qual at like 1920.
I want to move on. Emerging markets. I'm surprised that you like emerging markets, given how cautious you are on the overall global economy. Emerging market dividend payers. There is an ETF for that. This always amazes me. EDIV. Why do you like emerging markets and why dividend?
See, I think the opposite of what you just said. I think U.S. is riskier than emerging markets because you're trading at like 10-year highs in terms of valuation. So EDIV is just a quantitatively driven screen, strong earnings, strong dividend growth. It's 100 stocks. You know, if you're trying to outperform the benchmark, you need to do something different than the benchmark. So EDIV has very little overlap with EEM. It trades at 10 times earning. EEM is at 13 times earning. EDIV has outperformed EEM by like 150 basis points, so that's pretty good in my book. Higher Sharpe ratio.
Dave, gold, quality, and emerging markets. Reaction?
Yeah, well, so I think the emerging markets play is the most interesting one here. The thing to be cautious of with something like EDIV is you're getting a lot of sector exposure. That fund's loaded up on financials. It's loaded up on energy stocks. You're getting things like Gazprom in it, you know, names that we all know. So some might argue there's a reason some of those stocks are trading at PEs of 8, 9, and 10, but you're right. I think emerging markets is one of the greatest value plays we've got available in global equities.
Yeah, okay, I want to move on because we've got a special guest today. I want to end with one of the biggest players in the ETF universe out there. Vanguard currently oversees more than $1 trillion in exchange-traded fund. That's T, not a B, T. Joining us now, the man who runs it all, Rich Powers. He's the head of ETF product management over at Vanguard. $1 trillion, I know that's, you know, daily work for you guys over there at Vanguard. That's not a bad number here. ETFs are 20% of your assets right now.
They are, but they're about 35% of our cash flows over the last 3 years. We've seen more and more investors, be it financial institutions, advisors, and increasingly the individual investor embracing ETFs as a way to build a diversified portfolio.
So what areas are you seeing growth? Where's the money coming in this year? We've been hearing about bond fund inflows. I'm so tired of that story. I'd scratch my head. But what else are you seeing inflows in? Where are your people putting money?
Yeah, I mean, the most popular ETF in the industry right now is the Vanguard S&P 500 ETF, VU. It's about $10 billion in cash flows year to date. Also in our total market fund, be it the equity side of things or our total bond market. And then interestingly, total international bond ETF, BNDX, is a product where more and more investors are
These are all the biggest index products that are out there. And I want to point out, total stock market is essentially the entire, you know, is it fair to say it's the S&P 1500? I know it's not indexed to that exactly, but it's essentially the U.S. stock market.
Total
right?
U.S. stock market from the largest companies down to the smallest.
Yeah, and international. Also seeing some inflows or not, VEA, right?
VEA is very popular, so that's the Developed Markets ETF, and then BNDX I was mentioning before, so international fixed income investment grade. You know, despite the talk around low or no yields for international bonds, you're seeing more and more interest, less home bias amongst investors for fixed income.
But you guys have also launched a bunch of active products. Have those been getting the investor attention that you guys have hoped?
Yeah, so we launched a suite of factor ETFs, 6 factor ETFs last February. Slower uptake, naturally, I think, for us. Active requires a track record. We're about 18 months into their life cycle. It's a different concept, and so there's lots of education we're doing in terms of teaching investors how to invest with factors. It's not appropriate for all investors, but for some investors, they want to have very specific exposures.
I often hear about misperceptions about Vanguard. Somehow Vanguard is not in favor of active management. And I'm a Jack Bogle disciple from way back. I always point out Jack was never opposed to active management. Jack loved active management. Jack had Wellington, one of the great investment firms of all time, behind him. What he was against was high cost.
That's right.
And that the costs associated with the fees often destroyed the alpha that any active managers had. This makes perfect sense to me. Vanguard continues to have active management funds, some of which are very successful, although obviously if you're like Bogle concludes, it's really, really hard to outperform the market long term. An average investor is perfectly well served in staying in index funds.
Well, that's right. We have more than $1 trillion in active equity and fixed income mutual funds. The average expense ratio there is 20 basis points. We give those funds a fighting chance to outperform. That's no different from the factor funds we launched last year, which are all under 20 basis points.
John, where are you on the active versus passive these days? We encouraging your clients to do what?
We use a combination of both. So we're active management of, you know, passive ETFs or rules-based ETFs.
Yeah, you're a tactical investor.
Yeah, so we combine the best of both worlds, and I think that's really the sweet spot.
Can you do that? This is a good point here. Stop worrying about whether you're picking a guy to pick stocks. How about I'm picking your ETFs for you? Tactically, I'm moving in and out. That could be just as successful owning plain vanilla index funds if you're tactically moving around.
Well, I mean, anyone who's buying an ETF is effectively doing active management. Unless you're buying the Total World ETF VT, you're making a bet on the market being, you're tilting more towards large caps or small caps, and so every investor is doing some form of active management. It just runs a spectrum.
Yeah.
I'm so glad you said that, because that's not really the message that's being kind of, delivered.
Yeah. We're all active managers. They're just those of us in denial.
Yeah.
Let me ask you about the low costs. We keep bringing it up. The media gets very big on this. Oh, there's a new zero cost ETFs now, not 3 basis points. The VOO is 4 basis points. That's the S&P fund. SPY, your competitor, is 9, and they've been losing some. There's a core iShares IVV, S&P. That's about what you are. Does it matter at this point? I know it matters for big institutional funds, but would your message to the average investor is focus on something besides 3 basis points versus 4 basis points?
Well, I think there's more to it than just expense ratio when you get to these levels. When you're talking about 3 basis points versus 4 basis points, things like tracking error, tax efficiency, bid-ask spread, it matters a lot more versus if I'm comparing a 3 basis point fund versus a 30 basis point fund, I might be able to start and stop with the expense ratio comparison because that's going to guide whether a fund's successful or not.
Yeah, I like to point out, by the way, that Vanguard total stock market is probably the largest fund in the world if you include everything. Isn't it close to, how big is Vanguard total?
Oh gosh, it's got to be, when you add all the share prices together, probably $600 billion.
Yeah. I like to point that out to people. They don't quite get it. Before we let you go, how do you feel about this heavy concentration that I complain about all the time? You pointed out before in discussion, this has happened in the past. We've had intense concentration. The 70s, oil stocks had stupidly high concentration. Does Vanguard worry at all about that? Do they give any advice to their investors?
When you're buying a large cap portfolio, you're naturally, because the market is voting in terms of the price of and the shares outstanding, what the weights of those securities should be. And so the current weight of the S&P in the top 10 is really no different than it was 10 years ago, 15, 20 years ago. The constituents are a little bit different. If you were concerned about that, then you would go to a much broader fund and buy a Total World ETF where you're holding the entire U.S. world market cap, and that reduces your exposure to the top 10.
Or you can buy equal weighted, or even reverse, as you mentioned.
Yep, lots of ways to skin that cat.
I'm going to check this a little carefully. I certainly agree it wasn't that way all of there were times in the past where the concentration was this high, maybe higher, but 21% for top 10 seems pretty high to me. I'll check that. But thank you for joining us. I've been trying to get you on the show for a while. Of course, always love what Vanguard's doing. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Rich and Dave and John for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.